Welcome back to Macro in 2 minutes. Global stock markets have seen significant swings recently. Are we looking at short-term corrections or the precursors to a large-scale collapse? In this video, we'll unpack key indicators that will help you quickly grasp forces driving global stock market trends. Let's start with market sentiment. Are stock markets getting overheated? For that, we can look at the proportion of stock indices above their 200-day moving average. When the ratio hits 80% or 90%, it typically signals overheated market sentiment and potential corrections ahead. However, there's notable variation among countries. While 80% of the stocks on the Nikkei and Sensex are trading above the 200-day mark, in Hong Kong, Brazil, Singapore, and China, the number is actually around or below 50%. Also, overheating doesn't always translate to risk. When supported by strong fundamentals, pullbacks actually can present buying opportunities. Next, let's look at valuation. Are stocks getting too expensive, and is that a problem? We can look at the market cap to GDP ratio to assess if stock market valuations are supported by actual economic growth. That said, a high ratio doesn't necessarily mean the stock market is overvalued. This is because a country's stock market composition does not always mirror its economy. Also, constituents of major indices can change dramatically over time. For example, Hong Kong's market cap to GDP ratio is at a staggering 1,000%. This has to do with the fact that some Chinese companies may be listed in Hong Kong, but their production and operations are not in Hong Kong and are thus not reflected in Hong Kong's GDP. Liquidity environment is another crucial factor influencing stock market performance. One useful indicator is the net proportion of central banks cutting rates. A high reading indicates that more central banks are in the rate cut cycle, which improves liquidity conditions. This means more capital flowing into the stock market and lower borrowing costs for companies. Both factors tend to boost stock market performance, as seen in the rallies in the chart. The proportion has been rising from its lows. And we can see the stock market has started to price in the anticipated rate cuts as well. Last but not least, to monitor for market corrections, we should also come back to macro fundamentals. Here we look at 2 more indicators. First, Taiwan's export growth, a useful leading indicator whose turning points have led the MSCI ACWI index by around 8 to 12 months. The rationale is explained in this video. Currently, Taiwanese export growth continues to reach new highs, suggesting strong momentum and a good chance that the ACWI index will keep climbing. However, in the second half of 2024, investors should monitor for signs of slowdown in export growth, which could signal a reversal ahead. Another useful indicator is the Citigroup Earnings Revision Index, which tracks the number of upward EPS revisions versus downgrades. When the index rebounds from a low point, it means more companies are getting upward revisions to their earnings estimates. The index's 12-week average has been trending upward, signaling improved earnings outlook that can provide upward momentum for the stock market. So that's a wrap on some of the key indicators for assessing global stock market trends. For even more indicators and instantly updated data, check out our feature article or head over to the new chart collection here on our website. Thanks for watching, and we'll see you next time.